This week in economics on the 23rd of April 2016. On some of our outlets, you'll hear this on the 24th of April, but nonetheless, it'll be as timely. We'll explore several things today. We'll go to the market people and some of their PMIs, particularly on manufacturing in the U.S. We'll look at federal regulations as far as banks are concerned, and the larger banks too big to fail. We'll also look at smaller banks, their impact, how they have been impacted by energy loans. And we'll look at overtime, new regulations coming out there from the feds. Thus, let's move on here. We'll go to market first, and of course we'll do the numbers from the BBC to get an international picture. But firstly, we'll go to market, their PMI. This is the U.S. manufacturing PMI. The key points: U.S. manufacturing PMI eased to its lowest for just over 6.5 years in April. Production workers, production volume, close to stagnation and renewed slowdown in new business growth. Weak rise in manufacturing, weakest since 2013. At 50.8 in April, down from 51.5 in March. The seasonal adjusted market flash U.S. manufacturing PI, manufacturing purchasing manager index, signaled the weakest upturn in overall business conditions since 2009. The flash PMI index, which is based upon approximately 85% of the usual monthly survey replies, was only marginally above the critical 50%. No change threshold. As a result, the headline figure was slightly weaker than the previous post-crisis low recorded in 2012. That was 51. Softer rates of manufacturing output, new business growth, alongside a weaker rise in staffing numbers were the main factor weighing in on the headline PMI figures during April. The latest upturn in production levels was only fractional and the slowest recorded by the survey since the recovery began in 2009. Manufacturers cite general subdued demand conditions, delays in spending decisions among clients, and ongoing weakness within the energy sector. April data points to a renewed slowdown in new business growth, with the latest expansion the least marked so far in 2016. Some survey respondents suggested that uncertainty in relation to the economic outlook, political climate is an election year in the U.S. has weighed on client spending in April. Moreover, export sales continue to act as a drag on overall new business volume. Although only modest, the latest survey points to a sharp drop in new work abroad since November of 2014. Backlogs of work fell for the third consecutive month in April, thereby suggesting a lack of pressure on operating capacity across the manufacturing sector. The latest decrease in work in hand, but not yet completed, was the fastest for just over 6.5 years. This contributed to a near stalling of job growth amongst manufacturing firms in April, with the latest rise in payroll numbers only fractional and the weakest since 2013. Manufacturers indicated that tight inventory management strategies persist in April, led by the sharpest drop in stock of purchase, the start of 2014 at the same post-production inventories decreased at a modest pace, and manufacturers recorded a renewal for inputs. The latest data signaled the sharpest deterioration in vendor performance since September 2015, which some survey respondents likened to insufficient stocks and capacity cuts amongst suppliers. Average cost burdens increased slightly in April, therefore ending a 7-month period of sustained input price declines. Manufacturers note that higher labor costs and rising prices for materials and metals, and plastics have contributed to overall increase in their cost burdens. Factory gate charges decreased for the third month running in April by at only a marginal pace. Companies that reported a drop in their output charges generally cited subdued market conditions and corresponding pressure on operating margins. This is from Dr. Williamson. He's the chief economist at Market. U.S. factors report their worst month for just over 6.5 years in April, dashing hopes that the first quarter weaknesses would prevent temporary survey measurements of output and order book backlog are down in their lowest since the height of the global financial crisis, prompting employers to cut back on their hiring. The surveys are broadly consistent with manufacturing output falling at an annual amortized rate of over 2% at the start of Q2. It's where we are now. Factory employment dropped at a rate of 10,000 jobs per month, with prior month surveys data pointing to amortized GDP at 0.7% in Q1. The deteriorating performance of manufacturing suggests that growth could weaken closer forward stagnation in the second Q2. The survey respondents revealed an increase in business uncertainty in relation to both the economic and political outlook during the month, which weighed on spending and investment decisions, exacerbating already weak demand both at home and abroad. One of the situations that happens, and there is a graph here from the Bureau of Labor Statistics and manufacturing output from the Federal Reserve. One of the very interesting situations we have now, the Federal Reserve playing a very large role in the economy because of its dual, of course, mandate that the Fed has to deal with maximum unemployment and, of course, general stability of the economy from a macro sense. Let's look at we'll look at another PMI here. I think we'll look at the German PMI, composite PMI. Oops, we won't look at it in Deutschland. We will look at it here in the English. These were all incidentally on the 21st. The 22nd of April. The economic upturn in Germany slows further despite improving manufacturing performance. The flash German composite output index at 53.8 in March, a 9-month low. Flash service activity index at 54.6, a 6-month low, and flash German manufacturing PMI at 51.9. It was 50.7 in March, 3-month high. The flash German manufacturing output index at 52.2. It was 52 in March. Again, another 3-month high. A summary here. Output growth of German private sector companies slowed further at the beginning of Q1, as highlighted in the market flash German Composite Output Index falling from 54 to 53.8 in April. Although growth eased only marginally since the previous month, the latest expansion was as slow since last July. Service providers report a slight weakness in increased activity, while output at manufacturers rose at the strongest rate since January. In contrast, the trend for the output, the amount of new business placed with private sector firms in Germany increased at a faster pace. Some of the panelists commented that new order intake normalized after underwhelming in March. While, let me get back to the top here, others observed strong demand for foreign markets. Indeed, manufacturing recorded the strongest rise in new export orders in 2016 so far, with specific mention of China, Southern Europe, and the U.S. as sources of growth. Meanwhile, businesses were encouraged to further add to their payrolls in April, therefore extending the ongoing sequence of employment growth to 2.5 years. Some panelists hired additional workers in order to process backlog, the reverse of what happened in U.S. manufacturing, while others commented on increased new orders. The rate of job creation accelerated marginally since March, but remains below levels seen throughout most of last year. As has been the case since August of last year, backlogged work rose during the month, while panelists largely attributed to increased new order intake. However, with rising employment levels, the ability to relieve some of the pressures on operating capacity, the latest accumulation of business outstanding was only marginal. April data highlighted a fourth consecutive monthly fall in input costs faced by German private sector companies, largely as a result of lower raw material prices, exchange rate factors reported by manufacturers. That said, the latest fall in input price was a weakness in the aforementioned period. Despite costs falling further, businesses were able to raise their average selling price. During the month, German manufacturers reported the first deterioration in vendor performance for 3 months. During April, moreover, stocks of purchases fell at the weakest rate in 2016 so far. Service providers were the most optimistic, forward their 12-month outlook of activity in 3 months, according to the April survey results. Reasons behind positive sentiments included higher budgets, increased demand, and structural changes to their businesses. From market here, the German sector, this is Oliver Kadeski, I suppose. Anyway, is continuing its on spectacular expansion trend at the beginning of Q2. Although growth remains on expiring, the headline PMI dropped to a 9-month low. The index was down only fractionally since March and is still indicative of modest growth. Moreover, it seems as if the deflationary pressures are beginning to bottom out, with input costs falling only marginally and output costs rising. This development should provide some modest cheer to Eurozone policy makers at the currency union official CPI measurement shows that prices were unchanged in March. So this will do it for the market people. Now we'll go to, let's see what we'll go to first. The banks. And we'll get to the regional banks brace for losses from energy loans. We've talked about this before, this impact. 5 U.S. regional banks the most exposed to the energy sector. This is from Reuters, incidentally. Overall provisions for bad loans at the Regional Financial Corp here, Comerica and Keys Corp, SunTrust Banks, and Fifth Third Bank Corp more than doubled to $570 million in the period from $222 million a year ago. The low price in the oil environment continues to pressure our energy clients, which contribute to the increase in non-performing hours, our reserves, and provisional expenses. That's from William Reuters, chief executive of the Atlanta-based SunTrust, on a post-earnings call on Friday. We remain focused on being proactive around energy, therefore have increased the resources and intensity around migrating our risks and helping our clients navigate through the downturn. About 2.2% of SunTrust's total loans were linked to energy as of the 31st of last year, according to Barclays. The Dallas-based Comerica said this week its energy loan accounted for 6% of its total loans. The bank was identified by Barclays as having the biggest exposure to energy of any bank, of any U.S. bank, as a percentage of total loans at the end of the year. Should prices remain in the target area from 30 to 45 range, we'll continue to expect losses in the 50 to 75 million range in 2016. That is from Dave Turner, the Chief Operating Officer at Regions, said in a conference call. The Birmingham-based Regions has energy links exposure at 3.9% of total loans. That was, again, Key Corp, headquartered in Cleveland, and Fifth Third is running out of Cincinnati, have exposures of 2 and 1.8% respectively. U.S. banks are already under pressure from near zero interest rates, forcing them to resort to cost-cutting to underpin earnings as revenue remains weak. We hear more and more about phenomena at one time, out of Japan called negative interest rates. The Oklahoma City oilfield service company 77 Energy is the latest company to say it plans to file for bankruptcy. Dozens of others have already done that. I don't see the problem resolving itself in Q2 2016 unless we see sudden uptick in oil prices. That is from John Orrington, Chief Financial Officer at Amplify Credit Union in Austin, Texas. The non-performing assets of the 5 regional banks rose 60% to $4.35 billion in Q1. 3 of the 5 reported a drop in earnings. That's SunTrust and Regions Financial. Reported rise in profits helped by higher interest income. Commercer reported the biggest drop in quarterly profits among the 3. The Dallas-based lender's net profits fell 55% as it boosted bad loan provisions of more than 10 times to $148 million. And this is from the local bank perspective of there. And, of course, obviously the feds are keeping a very, very close watch on them. Now let's go to the bigger banks. Banks face, this is Basel funding rules to avoid some problems here. The banks face a push from global regulators to seek out a more stable funding that won't dry up in a crisis. Starting in 2018, international active banks were required to meet the so-called net stable funding rule that will force them to take into account the maturity of their assets when making choices about their financial mix. That's the Basel Committee on Banking Supervision, which brings together regulators from the Federal Reserve and the Bank of England. The rule would limit bank reliance on volatile short-term borrowing to fund illiquidity assets. That is from Stefan Invigas. He's of the Bank of the Swedish Central Bank, Sweden Central Bank, and the Basel Group chair. As a key lesson from the crisis has been the need to prevent over-reliance on short-term volatile sources of funding. The net stable funding ratio is a part of a broad overall of the Basel banking standard in wake of the financial crisis that toppled Lehman Brothers Holdings. Regulators said that the standard is essentially a response to the failed banks such as Northern Rock there. Essentially completed, the publication of regulation means that the Basel Committee has essentially completed its regulatory reform agenda and undertaken a promotion of more resilient banking sector following the crisis. Banks have warned that a draft of the Basel Committee proposal published in January, and this is usually what they always say, would drive up costs of equity trading, unfairly penalize them for carrying out repurchase agreements, and undermine the stability of operational deposits. Changes in the final text compared with the January version include that regulators would give some scope to exempt an asset of a bank's balance sheet from a stable funding requirement if it's clear that the asset is linked to a particular funding source in a way that liability falls due while assets remain on the balance sheet. Interbank loans. The Basel Group has adjusted the rules for funding of short-term loans, derivative trading assets posted as initial margins on derivative contracts on derivatives. The case of interbank loans with residual maturities of less than 6 months, the committee tightened compared with the January draft by forcing banks to back up at least 10% of such funds. That used to be normally the requirement with stable funding, with a minimum rising to 15% depending on the loan secured. The final rule also curbs banks' ability, compared with the draft, to allow banks to offset derivative liabilities and assets when calculating whether they meet the rule or not. Aggregate short falls, a sample of 101 large international active banks, 73% have met the January version at the end of 2013, according to Basel data there. For a sample of 107 smaller banks, 83% passed. There you get shortfall for banks. Did not meet the standard. Was 789 euros. That's for 995 billion. The Basel Committee brings together regulators from 30 nations to coordinate rules for their banks. In addition, the Bank of England and the Fed, that members include the European Central Bank, the China Banking Regional Committee. Let me just go back to another article here. This is from Bloomberg, incidentally. This is from U.S. bank regulators. Propose new liquidity demands for big banks. This is dated on the 22nd. Are set to propose a second two major demands on the amount of liquidity lenders need to have on hand to keep running through tough times. Interesting situation. This is from the Federal Deposit Insurance Corporation. So-called net stability funding ratio would require banks to back away from reliance on volatile short-term funding. The measurement stems from the International Court. We already talked about Basel. The new requirements meant to complement an earlier demand for lenders to maintain a 30-day stockpile of easy-to-sell assets to have a short-term stress. The 3 U.S. agencies are required to adopt a version of the rule approved by the Basel in 2014. Next week's voting was the last-minute addition to the FDIC meeting agenda. The controller of currency expects to take up liquidity proposal at the same time as the FDC. And the Federal Reserve so far has not commented on what is actually going on here. One of the items we've left out of our coverage has been the Russell 2000. Nonetheless, it's up 10.92. We don't want to forget the Russell Index, that's small caps stocks there, where they are very important. Now let's go to the BBC. We'll finally get over there. Thousands of people protest in Germany against U.S.-EU trade deal. Now this is the Transatlantic Trade and Investment Partnership. You've probably heard about that. The handy work of the Obama administration and U.S. capital. But it's not something that a lot of people like. In the German city of Hanover, now many carried signs reading "Stop Tippy," I suppose you'd call it. Tippy between the American continent and Europe is very dangerous for democracy. The rights of American workers have been taunted there. And what is Tippy? It aims to broaden the economies of the EU, to boast, by removing or reducing barriers to trade and foreign investment. Now that's where it gets a little bit treacherous. By eliminating almost all tariffs, taxes applied only to import goods on trade between the U.S. and EU. Much of the concern is about the regulatory aspect, which would lead to lower standards. Now, this is of consumer environmental protection and safety at work. Generally speaking, consumer protections, environmental protection, safety at work are much more stringent in the European nations. And I think what we're going to do here, we're going to talk a little bit more about, and you heard in the campaign, about too big to fail. Now, this is a speech from the Minneapolis Fed leader, ending a too big to fail initiative here. This is from Nell Kosinker, I think. I mispronounce his name every time. He was speaking to a local chamber of commerce. Today I will cover two main items. The first will explain why we launched a major initiative to end too big to fail. Now, he was also the man in charge of the TARP program. I'm skeptical that current efforts to fix the problem will ultimately work. I'll provide a few key examples for the recent financial crisis. Now, he ran what was called TARP, the Troubled Asset Recovery Program. Secondly, we'll summarize where our initiative stands today, and we have had our first symposium on it, and we'll devote a special program to it. The issue here, current efforts to address too big to fail. I've come to too big to fail a problem from a perspective of a policymaker who was on the front line in response to 2008, what we call depression, and he calls financial crisis. In the past 6 years, legislation and regulators have worked hard to address too big to fail problem. My colleagues at the Federal Reserve, working closely with other financial regulators, have implemented important tools and regulations that are making the financial system stronger on the reform framework. That's to remember the reform framework. I agree that many current reform efforts are headed in the right direction, particularly those that make the banks stronger with additional capital, deeper liquidity. We just talked about some of that. Stress testing, but I'm not sure that these measures go far enough. More importantly, we know that banks will still get in trouble. We need to find a way of dealing with failing large banks. The current reforms attempts to address the problem with a new legal framework to restore failing banks, combined with a plan to bring new investors into banks who agree to absorb losses when the banks get in trouble. The idea is that by having these new investors take the hit, the taxpayer would not be on the hook. Sounds good, but it not work in a practical crisis. My experience in 2008 highlights the problem. One of the toughest challenges we faced was dealing with risk spreading between larger banks. Multiple larger banks were under stress, and at the same time actions that we might have taken to recapitalize one bank by haircutting of creditors and counterparties could actually lead to increased stress on other banks. In other words, the old domino theory going there. This risk is one reason the Department of Treasury asked Congress in 2008 to authorize TARP, given the government's ability to inject capital into banks. Treasury announced in October 13th actually, of 2008 to simultaneously inject capital into 9 of the largest banks was done, part to stop the spread of contagion, in other words, risk. The challenge of sticking debt holders with losses also occurred in some enterprises he mentions here, Fannie Mae, Freddie Mac. We don't hear much about them anymore. Providing another example of the failure of debt as a loss absorber instrument during the crisis in 2001, the GCE, General Services, began issuing subordinate debt with special intentions. Nonetheless, during the crisis, because of the widespread risk in the financial markets, the Treasury chose to protect Fannie Mae and Freddie Mac. Basically took them over. Let me skip down a little bit of this. Our ability to impose losses on creditors of large banks is just as important now as it was prior to the crisis. The recent decision by the Federal Reserve and FDIC to deem the resolution plans of larger banks in the country not credible. Now, this is very important. The political candidate Bernie Sanders talked about this. He was ridiculed in the Daily News interview, and this proves that Senator Sanders was correct in his assessment. Updating our initiative to end Too Big to Fail. Experts from around the country will help examine it, and we look forward to covering this also. In our first ending it was on April the 4th, we heard from experts about the need to assess the costs and benefits of the proposal, costs and benefits of regulation, and they talked to a number of former experts here. And I'm just going to pare down on this because we will have a special on this. Substantially increasing capital requirements. Professor Antar Edmanti, I suppose, of Stanford presented her recommendations to substantially increase capital requirements for large banks before the crisis. Large banks average a 3% shareholder capital today with the implementation of Dodd-Frank and Basel III. We just talked about Basel III earlier there. Larger banks have a 6% of shareholders' capital. The presenter made the case that is far too low and should be closer to 25%. I agree with Professor Amenti. The advantage of substantially increased capital requirements are that the banks are a much better position to withstand the unknown. Because today most people don't realize that the taxpayers could still end up picking up some of this. Professor Simon Johnson of MIT, senior fellow at the Pearson Institute for International Economics, presented his recommendation to impose an effective cap on bank sizes of 2% of GDP, approximately $350 billion. His proposal is for capital requirements to be drastically increased if the bank exceeds the size requirement. Now, the number of proposals that are presented noted that increase in banks. Lehman Brothers, which had $600 billion assets, triggered widespread damage, while the eventual failure of CTI Group, there was an $80 billion operation there. Let me wind this down here. Next step, redirecting our first symposium, I am left with some important questions. Should we view proposals to address too big to fail in isolation, or should we combine them? How do the costs and benefits of proposed solutions line up relative to status quo? How much confidence do we have that the solutions will perform as expected in a crisis environment? Will markets think the proposal credible, puts creditors at risk or a loss? Will the solutions merely push risk into an unregulated area of the financial markets? Will the solutions promote fairness between regulatory burdens imposed upon large, medium, and small banks? How likely are these solutions to remain active over decades? Anyway, nonetheless, here on the 16th, the Minneapolis Fed's initiative. The next symposium is scheduled on the 16th. We'll hear from Professor John Cochran of the right-wing Hoover Institute, who will present his plan to tax leverage on financial systems as means of reducing systematic risk. In addition, we'll hear from John Bovary of the Bipartisan Center, and Oliver Wyman will present an alternative resolution mechanism. Now, we've had dealings with the Bipartisan Policy Institute dating back to when we worked for Jobs with Peace. Nonetheless, this was the professor's note here, and so alternatives are out there. Let's go to the back to the BBC before we forget what we're doing here, and get to the markets. Got a little long here, but sometimes it happens that we spend a little time trying to clear up some issues, and hopefully we didn't run too far over here. These were on Friday, unless otherwise noted, the market results. Okay. The BBC Global 30 was down 70.87 on Friday. The FTSE All Shares was down 35.12 on Friday. In Amsterdam, let me see where they were. $1.93. The DAC was down 98.92. In Paris, they were actually down 13.17. In Brussels, 8.30 on Friday. In Madrid, 36.60. In Zurich, negative 50.23. In Moscow, 11.70. In Johannesburg, a negative 294.82. In Bombay, negative 42.24. In Karachi, 120.42. In Lahore, negative 42.11. In Colombo, 0.48 in the negative. And on Wednesday in Tehran, a negative 161.90. In Sydney, negative 37.20. The Nikkei was at 208.87. In Hong Kong, the Hang Seng was down 155.21. In Shanghai, 6.35. In the U.S., 21.23. The Nasdaq was down 39.66. The Merck, 0.10. In San Pablo, 723.05 in the negative. And finally, in Mexico, 56.56. Very interesting number there. Let's look at the commodities, Brent crude in particular. And we'll see where the wheel spins. Brent crude futures were up 65 cents at $45.18. The spot was up 26 cents at $45.34. West Texas Intermediate crude was up 65 cents at $43.83. T. Boone Pickens was jumping for joy. He remembered $15 a barrel oil. And what else do we have? Cocoa was up $76. Dubai Gold was up $5.40 at $1,251.90. The Forex futures were down $6 at $1,243.25. Silver, for those that wanted to know, was down 13 cents at $17.19. And to the Internet Life futures, cocoa was up $20. Robusta coffee down $13. White sugar $6, down $6.40. The Bloomberg Commodity Index on Friday, negative 0.53. 83.05. And that will do it for us, for those in business. Make next week a productive one. For the consumer, obviously keep your eyes on the price. The price of petrol or gasoline has been going up, has been going down, and very, very difficult to say where those prices will be. I suspect a lot of fluctuation going on here, and will continue to go on in the volatile energy sector. And one of note, Google, Microsoft were all down. Google has the problem of dealing with mobile ads, something new there. And one analyst was talking about the restructure of Google as Alphabet, a more, I guess one would say, precise type of bookkeeping, make it very simple at Alphabet. The matrix used in terms particularly of cost. And Apple is having some problems also in China with some of their books and music outlets. They are blocked in China. And that is one of the more important things to look at. When you talk about the headset business, Apple in particular, how many headsets can a company sell globally, and that reflects on their profits. So on out, you will see less demand for some of these products, and of course, Alphabet's ability to sell advertisement space will become more realistic. And although here we deal with macroeconomics, we'll look some at the effects in the future, where the Microsoft, Google's, IBM incidentally had a loss. I think we reported that last time around, trying to get a new business model together, moving more to the clouds. Microsoft beat them to the cloud, and of course Apple's response was they bought cloud providers. Now they're in the cloud also. But the general tweaking of many of these organizations with their personnel to their new business models does take a while. Not only that, they're selling models with the staff that they have. You can buy a business, but you can't tweak it overnight into your business model, particularly in the large organizations like IBM, HP, because there's a culture there. And as long as you have the old culture, you cannot deal with that particular issue. That is goes into the psychology of the market. We've talked about that before, and in general economic psychology. We had market on this broadcast and talked about manufacturing. Now, I was looking around. Manufacturing over the U.S. obviously is not even. In the Midwest, and particularly upper Midwest, the manufacturers are going full blast, so to speak. They are using creative ways in small rural towns to get their workforces up. These are people that manufacture everything from forklifts to cement type items for construction. And one particular company I noticed was bringing in workers from Mexico legally, and then flying them back, flying in, flying out on peak times. Other workers, they bought apartment accommodations for the workers, something you see in India. But more and more, quote-unquote, creative solutions for these smaller manufacturers that I suppose roughly have 400 or less, maybe 500 or less workers at their peak times, but nonetheless, those are out there. And the whole change in manufacturing, increased overtime. One of the things we were going to talk about was Dr. Rausch of Berkeley, and he had a piece in the New York Times on the new overtime rule, very, very important. We'll put that into a future broadcast, and also on our sistercast from WBRN Radio, Bostonred, the political broadcast. We'll also talk about that. But overtime in itself is a very, very important factor in. So to sum this up, basically we are seeing the Fed, the FDIC, and various government agencies tweet their regulations. And that will go to the Department of Labor tweeting the overtime rules. All of this to pull out some of the inequality in the American economy, and also at the same time too big to fail. That could still fall back on the taxpayers. And 6% is a very, very low figure. 25%. It used to at least be 10%, 15% for banks. In other words, that's how much capital they should have on hand to deal. But there's more exposure today because of the development of risks, and also after Glass-Steagall and the Clinton administration took it off the books, we have the Citicorps and various banks, the investments banks, commercial banks, merged in there, and we have sort of a cross-pollinization, as one would have it. Anyway, enough for the spill here. We'll talk to you next week on the week that was. Good day, and have a good weekend, everyone.